Hello and welcome to the Small Business Briefing. I'm Brian Calley, coming to you one of these on-location days, actually over at Washington Community College, who is a friend of small business, on the team at SBAM, where we'll be doing an owner-to-owner networking meeting this afternoon. But of course, it's 3 o'clock on Thursday, so we're doing the briefing.
Hi, Brian. Hi, everyone. I'm Sarah Miller. I'm the Vice President of Marketing and Strategic Communications, holding down the fort here at SBAM headquarters. I want to say thank you to our sponsor, Consumers Credit Union. You can learn more at consumerscu.org, and I think there might still be time to participate in their March Goodness Tournament. If you look them up on social media, you can help them determine who they give some charity money to. So consumerscu.org, or find them on social media. So Brian, let's start with the decision by the Federal Reserve to raise interest rates yesterday. What does this signal about inflation, and was there any dissension in making this decision?
Well, there was certainly there are people that have different opinions on it, but the decision of what to do, the 0.25% increase in the interest rate, was unanimously arrived to by the members of the Federal Reserve Board of Directors. So there was no dissension among the actual decision makers. There are some people questioning the decision, but I actually think that it was probably the right direction to go because right now there are a lot of factors out there in the economy, and not moving forward with their plans to increase the interest rate may have sent a message that they were more concerned than what they actually are about the banking industry. So the decision itself would indicate that the Federal Reserve is not satisfied with the progress made thus far in taming inflation. And the reason that they're not satisfied is because the service sector, the price increase pressure in the service industries, it's still really moving up. We saw as of last month, and core inflation now 3 or 4 months in a row has been leveled off or increasing, as opposed to that downward trend that we saw for a little while. And so I think that's the main thing, that the Federal Reserve is more concerned about inflation than any other thing. And history would suggest that inflation is very, very problematic when it persists at high levels. And so there's a determination to get it under control. Although I thought there were some signals about an expectation, though, that this monetary tightening that we're process that we're in right now might be coming more to its end through this year, during this calendar year, and by the end of the year, beginning of next year, perhaps there would be some easing of those interest rates by then. But overall, it was very, very clear that the Federal Reserve was just not satisfied with progress made yet on inflation, and that is solely because of service inflation, because we do see now some deflationary impacts in the goods half. So you got two big categories: services and goods. Goods prices are coming down, but in services, not yet. Services would typically be the last thing, but I think the Federal Reserve expected that they would see service inflation cooling off by now, and so far it's not.
And so what do you see are the overall ramifications for the economy?
Well, there are several factors at play right now, and in terms of the overall position or ramifications for the economy, I actually, as I watched the press conference after the fact that Jerome Powell did, I thought it was he seemed less confident about a soft landing than in previous post-meeting press conferences, and so he was asked about the potential that the economy can cool without crashing, or cool without a hard landing, if you will, and his answer was, is to quote here, the question will be how long this period will be sustained, how long this period higher interest rates would be sustained, and therefore the monetary tightening or the high inflation and the monetary tightening or high interest rates to deal with that inflation. And then he finished up by saying there is a pathway. So saying depends, are we going to avoid a deeper recession? Basically, his answer was it depends. And at the end, he said there is a pathway, and we are trying to find it. It made me yearn for the old days of Alan Greenspan when he was chair of the Federal Reserve, and he was always so confident that we're going to do this and we're looking for this outcome, and I'm confident we're going to get there. This Federal Reserve was very, very late to act. They confidently asserted that inflation was not a problem for a time. Therefore, they acted late. A lot of the federal policies, particularly in the monetary front, exacerbated the problem, and I think it has shaken the confidence. And I would love to see a little more confidence now that they're taking steps that are what I would call like the normal steps that you would take in this type of situation. I'd love to see more confident verbiage from the chair of the Federal Reserve. But still, good that he at least acknowledged that there is a pathway to a soft landing. They're trying to find that pathway, obviously, but I think there are a lot bigger concerns today about a deeper recession. I no longer hear people saying, the economists out there and the pundits around this area, I no longer hear people talk about if there will be a recession in 2023. And now the discussion is really about whether it will be a hard recession or not.
And so it seems like there's this balancing act in the fight against inflation. We have the health of banks. So what are the chances they can thread this needle, find this soft landing, and not cause disruption to the financial sector and kind of get inflation under control?
So the banking situation is a new factor. So before, they're balancing these two things, risk of recession and inflation. Those are the things that they're really trying to make sure that they can get inflation under control without causing a deep recession. The stability of the financial institution, the shaken confidence of investors and depositors is a brand new factor. There's no question that this is on the mind of the Federal Reserve. While they did move forward with their regular plans of the expectation of a 0.25% increase, which they set last time, they went through it, they did not change that. But I also, I know that they know that when banks are faced with liquidity concerns, so this idea that people could walk in tomorrow and just withdraw all their money and kind of mess up the balance between the assets and liabilities of the financial institutions. There's no reason for that to happen, but things happen in the world of social media. Things happen really quick these days, and so banks are going to want to keep more liquidity on hand, and that means that they would probably tighten their lending criteria and do less lending in general. That will have a deflationary impact on the economy that will probably be bigger than increasing interest rates. So again, I'm trying to getting in that a little bit of the policymakers here, but what I expect is that the fact that banks, as a result of this liquidity concerns, are probably going to pull back on their lending activities, will do more to keep inflation keep inflation tamped down and maybe lead to deflation, to where the Federal Reserve might expect that they're going to be done with interest rate increases after this, and maybe there'll be another one or two smaller interest rate increases in the future. But I saw signaling that they're back to this mindset of we're near the end. If banks pull back on lending activity, it will work together with high interest rates to get inflation under control, probably faster than what they otherwise would have expected.
Let's talk about the banks again a little bit, and kind of what the role of social media and the role social media played in some of those issues we saw. It's kind of unprecedented,
Yeah.
and we haven't seen that before.
this was the part that was kind of, I was glad that it came up. It actually came up in the questions with Powell. And and I was glad it did, because social media played a role, as far as I know, for the first time ever. And this isn't like, if you think about like the banking crisis of 2008, 9, just the kind of the financial world, it had to do with a faltering economy and impairment of assets of banks, which are loans. In other words, loans not, that loan portfolio is not being healthy, people unable to pay back their loans. What's happening now is very, very different. This is purely a liquidity challenge where in a couple of banks, people withdrew a bunch of money all at the same time. This is a good old fashioned run on a bank that you've not seen that in this country for quite some time. If anybody in the audience seen It's a Wonderful Life, and Jimmy Stewart is the banker, and everybody in town is trying to pull out their money, and he said, "I don't have your money. It's in Bill's house, and it's in this," like that. That is actually a pretty decent picture, an old-fashioned picture, but a decent picture of this type of thing that a couple of banks in the U.S. faced a few weeks ago. That's just so different than what had happened before. Now, why did it happen is a good question. Silicon Valley Bank is the one where it started, tech industry, but there was really a financial, but really social media influencer that didn't like that they had cashed in on bonds at a loss to essentially make up some of their liquidity needs, because in the tech industry, which a lot of their clients were in the tech industry, they were burning through their cash. It wasn't that those companies were taking money out to move it to another bank. They were just losing money, and therefore their cash on hand was declining. And in order to deal with that, this bank cashed in some bonds at a loss, because interest rates are up, interest rates go up, net present value of current bonds goes down. And the social media influence lost confidence. This influencer lost confidence in that bank and said, anybody that has money there, you ought to pull your money out. There's really a high correlation between that and what actually happened. And so it just kind of caught on, and then all of a sudden there was a run on this bank, and it made them, it's a new factor, and it seems to have been triggered by a social media opinion that led to behaviors that caused the failure of a bank, and that is a brand new factor. So Powell was asked about that, and I'm not sure what to think about his response. He said a rapid run on the bank was different from what the Fed has seen in the past. Obviously, social media has not played a role like this in the run on the bank in the past. And he suggested that it will need to, that the regulators, the banking regulators, will need to update their regulation and supervision to keep pace with this change. That's how does a regulator, how do you come up with regulations around that? What I'm a little bit concerned about is they might change their expectations of liquidities that banks need to have on hand. Now, if banks keep liquidity on hand, this is just like your business. I want everybody out the audience, think about that. If you have money sitting in your checking account, that money is not making you money, right? When you deploy it in your business and the core thing that you do to make money, that's when that money is invested to make more money. In banks, when they just have money sitting in their Fed funds account, yeah, they get an interest rate on it when it's sitting there, but what they make money is on lending, making loans. And if the regulators say, hey, in this new world of things can change like that with social media, and a run on a bank can happen because of influencers there causing a run on the bank. So therefore, we need banks to keep more liquidity on hand. That would have a detrimental impact on the overall profitability of banks. If there's a detrimental impact on the profitability of banks, then fewer people are going to want to invest in banks. And so you can see how that could cause some issues. I'm speculating here out of his answer, which was just that they're going to need to update their regulations. I don't really know what that means. Nobody knows what that means at this point. But this factor where social media actually played a part is a new factor and one that regulators are going to have to figure out whether or not they need an explicit or a specific response to it.
Pretty wild to think that social media could play such a role in these actions. So let's talk about the overall ramifications for small businesses and their access to capital. What advice would you give our members? And while you're answering, I'm actually going to drop a link in to a video that you filmed earlier this week that kind of talks about the banking industry as a whole. And I think it's offers some good insight. So I'll do that.
Yeah, if you have 14 or 15 minutes, I did a video which is a kind of banking 101. So you can just really walk through everything that has happened, what has changed, what's the big deal about all this. And my goal in that video is to maybe help people understand that the risk profile of the banks that failed, the two banks that failed in the U.S., were not representative or indicative of how the majority of the industry looks, but also to help you understand what happened. Because even with those banks that failed, frankly, there's just not a good reason for them to have failed, other than a bunch of people at the same time decided to pull the money out of the bank. Absent people making that decision, neither one of them would have failed. That's the frustrating part. I'll say especially Signature Bank in New York, because of the clientele and the risks that Silicon Valley Bank took. I guess I maybe with the tech industry, if there hadn't been some kind of recovery, maybe they would have had some credit quality problems in the future. But it was definitely different. So here's what I think, though, will be the ramifications and the practical impacts on small businesses in the future. And that is that most banks will naturally come to the conclusion that, at least for a while, they need to have more liquidity on hand. So in other words, they need to have just cash in case people withdraw from their savings and CDs and checking accounts at a level that's higher than normal. So that need to keep more liquidity on hand, the fastest way to do that is to cool off their lending, is to not make as many loans in the future. Now, this won't affect things like mortgages, because mortgages are most of the mortgage market is residential mortgage is like they're sold in the secondary market. The bank is actually not usually lending from the deposit pool on mortgages. There's like a different market for that. But on business loans and commercial lending, which that is just the core liquidity of the bank, they're going to want, banks probably are going to want to keep more liquidity on hand, which means that they're going to want to make fewer loans, especially business loans, which tend to be bigger. And so that could have an impact on the ease of getting capital, cost of getting capital. It's also, I think that it's reasonable to assume that credit standards will tighten, or they'll increase credit standards. In other words, cash flow that they're going to want to see, sales trends, how much collateral they're going to want on loans. I think it's reasonable to assume that just all of those things will get a little tighter in the future. And even if a bank was not inclined to do that because they felt like they are really liquid and they've got lots of extra capital, I think that the regulators, they're already sending signals that is their expectation, that there be really strong liquidity plans to avoid the possibility. You might ask the question, why do the regulators care so much about that? It's why, the banks are private industry, but bank accounts are insured by the Federal Deposit Insurance Corporation, the FDIC, which is part of the federal government, up to $250,000. If it's a joint account between a husband and a wife, you get, or not just between two people actually, then it's, both get that $250,000 covered. So you can actually get a lot of coverage and guarantee on your accounts, even in the face of a bank failure because of the FDIC. But because there is this federal deposit insurance, regulators, I think, are going to want to see banks maintain more liquidity. It will tighten the credit market. I think it just makes sense in the future here for small businesses to assume that their access to capital will be a little harder than it has been in a little while. Let me make one more suggestion, just a practical suggestion for those of you who have bank loans right now. So your bank loans have debt, if they have debt service covenants or other types of covenants, and you have to report, maybe you have to give quarterly financial statements to your bank that they look at and determine, are you meeting all the kind of risk standards that they have for the loan that you have outstanding. I would recommend that you not leave anything to the imagination of your banker. In other words, if there's anything unusual or different about the trends in your financial statements, maybe your cash position is lower, maybe your accounts receivable have gone up, if your sales have leveled off, if they went up, tell them why it went up. If they went down, tell them why it went down. If your overall profitability has changed, your margins have changed, you know what you're going to do to deal with that. But if you don't tell your banker that, they just have to assume that this is a picture of how it's going to be in the future. So let me just give you an example. I was talking to a business earlier today who was telling me that the cost of labor has gone up 9% in his business. So same number of people, but it's 9% more expensive than it was a year ago. This squeezed the margins, and he just had to live with that squeezed margin for now. But as the agreements with his customers roll over, there'll be an increase in the prices that are charged in the future. That would be a perfect example of something that you would want to share. You hand your financial statements over to your bank, and it shows some compressed margins. Your profitability is lower this year, but you're going to have a repricing opportunity coming up. You're going to want to explain that as you give the financials, maybe a little narrative to go along with it. I know that the margins were compressed. They were compressed for this reason. Here's what I'm going to do about it. Here's how it's going to be in the future. Maybe even give a projection of what it's going to look like in the future. Telling that story is going to be powerful. And I know there's probably a lot of people out there that are thinking, oh yeah, but it's set. Don't have to worry about this, but been with them a long time. I got bankers beating down my door and always wanting to get my business. But I don't think that you can count on the credit availability to be as loose as it has been in the past. That's not to say that I think it's going to be like 2008-9, where a bunch of banks redlined Michigan. I do not think it's going to be like that. But I do think credit standards are going to change. And I would really implore people to consider giving or instilling confidence in those who are taking a chance, lending you money, and helping them to be confident in you by not leaving anything up to the imagination as you're sharing your financials, your tax returns, your quarterlies, whatever it is that you owe the bank, for those of you who do have bank debt.
All right, that's really solid advice. We're going to switch gears now and talk about some legislative updates. First up is right to work and prevailing wage, which we have covered quite a bit. Brian, you recently wrote an article that summarized the small business impact well, and I'll go ahead and share that link here. But could you give us a high-level overview of where things stand today?
Well, it's basically done. The policies, I believe, are set and on the way to the governor. They were recalled actually by the legislature for some modifications. There is an appropriation, a spending line that was put in each of these bills. And it was put in the bills because that makes it referendum proof. So the people of Michigan can't reverse the legislature, per our Constitution, cannot reverse the legislature's action through a citizens initiative if it's a spending bill. Well, they had an appropriation to make sure that the people can't overturn the decision later on, but they did it wrong. So they recorded it and made an amendment to correct how they did this referendum proofing. They call it referendum proofing the legislation. So they did that, but they also made the On the prevailing wage part, which is regulated by the Department of Labor and Economic Opportunity, they stiffened the penalties. They made it much, much riskier for a non-union business to even bid on or to win a prevailing wage contract with the government, and kind of weaponized the department, if you will. I think the original bill, the way they passed it already, kind of essentially redlined a lot of small business from this activity. They definitely made it worse. But as a practical matter, I think that many small businesses would have walked away from that type of business anyway before they made that change. So it is on its way to the governor. The governor definitely will sign it. I think the big question is, will is this it on the labor law changes, or will there be many more? I wanted to share something with you that just popped up this week in Lansing. So on 496 by Pennsylvania, so pretty busy intersection. There was a new billboard, and here it is. I know there's a telephone pole in the way of it, but you can get the idea here that this is a billboard for Florida in Lansing. And Free State Florida, protect your right to work. And they even, here's the part, definitely kind of salt in the wound, if you will. They take our state motto. It's in Latin, but it's not in our state seal. If you seek a pleasant peninsula, look about you. And if you seek a pleasant peninsula, move to Florida. And this is about the right to work. I think that there's already a migration of people from Michigan to Florida since between 2020 and 2021. Michigan saw outbound migration of 43,000 people. Florida was the biggest beneficiary of that. I saw an article that was really talking more about social issues, not economic issues, but they were kind of celebrating Michigan as the anti-Florida, but the way that people are voting with their feet, I mean, Florida is growing a lot. They average about 1,000 people, net increase of 1,000 people a day, and that legislation has not even hit the governor's desk yet, and it's being used to essentially raise awareness of Florida as a good place to do business. And it is and I've also even yet today hearing from site selectors and consultants on locations and expansions. Michigan people are getting warned off about Michigan left and right now. The site selectors won't say that, they won't make a big statement to anybody because they don't need protests. They don't need people mad at them, but generally they're just consultants for individual companies. But companies of all sizes, a company that I talked to earlier today that was working with some site or location consultants, and it's about 200 employees, and just the mindset was the consultant recommendation was there's no reason to even look at Michigan. Look at what's already changed in the last month. There's a lot of things in the pipeline. So this is the type of perception that we have to deal with in the future. And the fact that this billboard popped up, I think, is an indication that we're at a vulnerable position here. We're already facing some headwinds economically, nationally. We are, and I really sincerely hope that the policymaking body, the legislative process, that they can tap the brakes on big sea change type policy maneuvers that make us less competitive and more difficult to offer jobs in. Because this issue now, we have more jobs than people. It wasn't that long ago, 2008 and 9, when we had way more jobs or way more people than jobs. And we definitely don't want to find ourselves in that type of position.
All right, one final update for today, the earned income tax credit. Where does that stand right now?
SBM has been a long-term supporter of the earned income tax credit, something that people on the left and the right agree on. And it's being increased through a bill that already passed, that big omnibus tax bill that passed, to 30% of the federal credit from 6%. So a big increase, which is good. But because that bill got entangled with a bunch of stuff that was very controversial, it didn't get immediate effect, which means it doesn't go into effect until next year. There is a new bill that has been introduced into the Senate and has already been reported out from committee that disentangles the earned income tax credit from all those other tax issues and would give it an effective date of this year. So I don't know for sure if that's going to make it through the process yet, but good encouraging signs that an issue that we support for the purposes of encouraging work and rewarding work, earned income tax credit can only be used by people who are working. So it's a reward for people who work, even if their income is lower. Or I should say, only if their income is lower. I mean, it's a low income, earned income tax credits for lower income people, but it really goes all the way up to over $50,000 in terms of qualification. If that passes yet this year without being attached to other bad things, then I think we'll count that as a big win, especially in the context of some other pretty tough things that have been working through the process as of lately.
All right. Well, thanks, Brian. Thanks everyone for joining us today. That's all we have. We'll be back here Monday at 3 o'clock. Have a great rest of your week.
Thanks, everybody. See you on Monday.